The three names that began trading as receipts this morning are easy to read as a product launch and hard to read as a strategy. That is a mistake. Grab and Sea are South Asia's two most recognizable listed technology franchises. SpaceX, 6 weeks removed from the largest initial public offering in history, is the frontier name that does the marketing. Bundled together, they look like a curated retail menu, the familiar and the aspirational priced in Singapore dollars. But the composition is the point out here. SGX did not add three companies, it extended a wrapper shelf into a fourth national market and it did so over securities whose primary liquidity sits several time zones away. What the SGX is doing instead is quietly coherent because if you cannot win the contest for where the company is domiciled, you compete for where the exposure is traded. The depository receipt is the instrument that lets an exchange sell access to a security that it never hosted. Denominate it in local currency, settle it at local hours, clear it through the local depository, and a retail base that would never open an overseas brokerage account can hold the economics of a Nasdaq share as if it were domiciled. Hello everyone, welcome back to our channel and welcome back to another episode of Capital Insights. In this episode, we wanted to share with you the access layer and SGX depository receipt expansion and the aggregation venue strategy. Essentially, what happened is that on July 22nd, SGX admitted Singapore depository receipts over Grab, Sea, and SpaceX. Its first receipts over US listed names and the cleanest signal yet of a deliberate posture. Having seeded the contest for primary listings, Singapore is competing on access, becoming the Singapore dollar wrapper venue for regional and now global equity, monetizing flow rather than domicile. The pull is structural and real. However, the unsponsored receipt model it rests on caps how far flow capture can substitute for capital formation. With this context, let's do a deep dive and let's try and understand how the composition is the signal out here. The three names that began trading as receipts this morning are easy to read as a product launch and hard to read as a strategy. That is a mistake. Grab and Sea are South Asia's two most recognizable listed technology franchises. SpaceX, 6 weeks removed from the largest initial public offering in history, is the frontier name that does the marketing. Bundled together, they look like a curated retail menu, the familiar and the aspirational priced in Singapore dollars. But the composition is the point out here. SGX did not add three companies, it extended a wrapper shelf into a fourth national market and it did so over securities whose primary liquidity sits several time zones away. The momentum data that SGX released alongside the debut is the part worth dwelling on. Turnover in the receipt product has more than tripled in a year. Assets under management have risen more than 150% to cross Singapore dollars 280 million, and more than 4/5 of the holdings sit with retail. Those are small absolute numbers against the exchange's cash equity base. Read as growth vector rather than a level, they describe something deliberate, an exchange that has found a product it can scale without depending on one single thing that it has been unable to secure. New companies choosing to list in Singapore. And this brings us to from domicile to access. The strategic backdrop is a listings route that no amount of task force messaging has reversed. Singapore has struggled to attract primary listings of scale, and its own regional champions have voted with their prospectuses. Grab lists on Nasdaq, Sea on New York Stock Exchange. Now the home exchange lost those franchises to New York at the moment that mattered, capital formation. And it's not getting them back through a listing rulebook. What the SGX is doing instead is quietly coherent because if you cannot win the contest for where the company is domiciled, you compete for where the exposure is traded. The depository receipt is the instrument that lets an exchange sell access to a security that it never hosted. Denominate it in local currency, settle it at local hours, clear it through the local depository, and a retail base that would never open an overseas brokerage account can hold the economics of a Nasdaq share as if it were domiciled. And a retail base that would never open an overseas brokerage account can hold the economics of Nasdaq share as if it were a domestic line. The exchange collects the trading, the custody chain collects its fees, and the underlying company, crucially, need not be involved at all. Singapore as a listing venue is an ambition. Singapore as an aggregation venue is a strategy actually being executed out here. Conflating the two flatters the first while obscuring how much it rests on the second. SGX is not trying to be where the company is listed, it's trying to be where their exposure is aggregated, the Singapore dollar access layer over markets that it will never host. And this brings us to the unsponsored advantage and its price. Now, the mechanism that makes this scalable is the same mechanism that caps it. SGX receipts are unsponsored. They are manufactured by an intermediary. Philips Securities acts as a depository and the issuer, which holds the underlying shares through an overseas custodian and issues receipts against them, with no agreement with and no participation from the underlying company. Each receipt is a set claim on an underlying share's economics. Two-way convertibility between the receipt and the share lets the market maker keep the two prices in line. The strategic value of unsponsored here is that it removes the counterparty who could say no. SGX does not need Grab, Sea, or SpaceX to want a Singapore presence. It does not need to negotiate a deposit agreement, count a treasurer, or wait on a board. It simply identifies demand and manufactures supply. And that is why the shares can march market by market. Thailand in 2023, then Hong Kong, then Indonesia, and now the United States, as a repeatable issuer-independent playbook. Slow capture without permission is the whole design out here. Now, the price of that independence is that the product is by construction a thin systematic, but no issuer stands behind it. Liquidity depends heavily on a single market maker showing up each session, and the receipt is classified as an excluded investment product and skews overwhelmingly retail. So there is no deep institutional book beneath it, and the wrapper conveys the economics of the share stripped of its governance. A claim on dividends and price, not a vote. It is an exposure engineered for convenience, not ownership engineered for control. Next, let's talk about the American mirror out here, because the instrument that SGX is deploying is not novel. It's a deliberate borrowing from the venue that perfected it. The American Depository Receipts is the same wrapper concept, a locally traded, locally denominated convertible receipt over a foreign share. But it grew up as the incumbent's tool of dominance, not a challenger's workaround. Two distinctions carry the contrast out here. First and foremost, the American market is overwhelmingly sponsored. Foreign companies come to it voluntarily, sign deposit agreements, and treat a U.S. receipt program as a coveted route to American investors, index eligibility, and prestige. The unsponsored corner, the one that SGX occupies, is the thin, over-the-counter fridge. Secondly, and more decisively, the LDR leveler tops out in the primary capital formation. At its deepest level, a company actually raises new money through the receipt via a registered U.S. offering. The wrapper becomes a funding event out here. This snapshot gives you the structural comparison between the ADR, that is the US model, and the SGX SDR, that is the Singapore model. It's the wrapper as dominance versus the wrapper as the workaround. And here you can see the comparison in terms of the issuer relationship, capital formation, relation to listing, investor base, liquidity architecture, and the rights convened. As you can see, the asymmetry is the thesis out here. The United States won both layers. It became the world's dominant primary listing venue and then built the deepest wrapper market on top of that victory. The ADR was the complement to the listing dominance. Singapore is attempting the wrapper layer as a replacement for the listing base that it does not have, using the unsponsored shallow end version of the instrument with no path to primary capital formation. That inversion is simultaneously the cleverness of the strategy and its ceiling. Let's wrap up this video with our positioning view. Now treat SGX Depository Receipt Build as an access and distribution franchise, not a listing recovery. The signal to monitor is not the three US names themselves, but whether the unsponsored shares keeps extending market by market and whether the institutional depth ever forms beneath the retail float. The tell that Singapore is aggregating flow at scale rather than merely renting it. Against HKEX, which retained its primary listing franchise and can wrap from a position of strength, Singapore is running the same instrument from a weaker end of it. The structural pull is real, repeatable, and investable. The hub maturity framing that accompanies it is marketing. The listing problem is not being solved out here, it is being routed around. So for allocators, underwrite the flow, discount the pitch. That's all that we have for you in this particular episode of Capital Insights. Stay tuned in for the next one.